Question number 4. Refer to employee 2, Sophie Cole. Calculate Sophie Cole's tax liability for the 2020 year of assessment. And Gojira Limited withheld 130,000 rands of pay-as-you-earn in respect of a 2020 year of assessment. Wow, they're telling us that. Of course we know. Right, so question number 4. Description. Explanation. There was no CGT in this question, was there? But, oh yes, there was. Actually, I have to think back to it now. So there's a CGT column for us. Remember, depending on how you studied, where you studied, you might want to do CGT separately in a different manner. That's fine, as long as you just do it in the right spot. And that is before your section 11F deduction. Okay, so let's go and see what happens to Sophie. So a couple of things again. Quick reminder. She is 41 years old. She's worked for the company for 17 years. So that means she's worked at least 15 years, which is the first requirement for the first time she qualified for a long service award. 15 years, then 10 years, 10 years, 10 years. She earns mainly commission. Section 23M does not apply therefore. Right, so she receives a salary of 9,000 rands a month and commission of 512,000 rands. Salary 9,000 times 12 and commish. That good old commish. 512. Right, then a note 2.2, she gets a laptop. Laptop to use. There is no value as used mainly for work. Right. Note 2.3. This is the award ceremony. Nice. So this is where she gets 2 Kruger rands. The company purchased it for 19,800 rands. So that's the amount including VAT. Remember, VAT is 0. And at the time when she got it, it was worth 20,100. So this is the question. Does she include the market value when she receives it or the cost to the employer in her taxable income? What's the theory? So the theory says, remember, or the Act says, when an employee receives an asset at less than, I'm just calling it its value, right? The situations are, if employer purchased asset to give to employee, sorry, that purchased underline is not as important, to give to the employee. Wait, what happened there? To the employee. Then you must use cost to the employer. If the employer did not purchase it specifically for employee, didn't specifically to give to the employee, let's rather say, then you use market value. And trading stock, if it's trading stock, you use the lower of cost market value. That's basically the rule. Now, why is this important? Because this employer went out specifically. Why did they buy the Kruger rands? They bought it because they wanted to give it to her. So we have to use the 19,800. She then sells it. Is it gross income for her? Is it a scheme of profit making? No, there's nothing here that indicates that she is doing it in a scheme of profit making. It's capital nature. Right, so all of those things in mind, let's go and see what happens. So 2.3, long service award. Cost 19,800 was, times 2, that's the amount we want to include. Right, so this is an asset at less than value for each benefit. But this is she gets the long service award exclusion, which has been 5,000 rands for basically as long as I've known any form of tax. Even when I studied, 34,600 gives the cash equivalent. When I studied, I mean, it's a while ago, I suppose not that long ago, 5,000 seemed like quite a bit. And now, it definitely didn't keep up with inflation. Right, so remember guys, that's the amount including VAT there because they are zero rated. Then she sells it, sale of Kruger Rands. Proceeds, it's capital in nature. Proceeds, she sold it for 20,500 rands each. Right, what is the base cost? I like this. Is the base cost the cost? Is it the market value when she received it? Is it the cash equivalent? What is it? The answer is, it is the cash equivalent. Right, and you can go and find this reference in paragraph 20. Always remember, if you want to know what base cost is, go look at paragraph 20. That's more than likely where it's going to be, because that's where all base costs are discussed. Paragraph 21H IIBB. Big reference, don't expect you to remember it. Obviously, make sure that you can flag it. That section says, if you've had a fringe benefit, if you received an asset for a fringe benefit, you're disposing it, the cash equivalent, the amount included in gross income. So it's 34,600. Think about the logic about this, guys. This person has already been taxed on 34,600. The rest has not yet been taxed on this 41,000. Yes, it's not normal tax. It goes into our CGT column, but that is it's still being taxed in a form. All right, so that's our capital gain. Then we have the travel allowance. Now, before we do the travel allowance, remember you have to do the travel allowance a little bit towards the end, after you've done everything else, before you do CGT. But CGT is before you do Section 11F. So the last bit of your calculation looks like this. Section 18A for the nations. We're building it up. Section 11F, capital gains tax, travel plus subsistence allowances, and then everything else. Gross income, exempt income, deductions. Remember that order here. Okay, so before we do the CGT, we have to do the travel allowance. But we have to do the travel allowance basically when there's nothing else left. So 2.4 is the travel allowance, 2.5 is the medical. Right, so we're done. So we can do the travel allowance. We're ready to do it. Okay, now, I always use the same approach for my travel allowance. And is it 2.4? No, it's 2.4. I'm going to do the same thing now. I always start with kilometers. Now, even if they give it to me, and this is a place where you might disagree with me, and that's cool, but even if they give it to me, I like to write it down, because I like to have everything in front of me. I want to acknowledge what the amount is, so that I can deal with it in this question. So I want to score the maximum marks of travel allowance. Easy place. Right, 32,000 kilometers in total, 6,000 with a private. So this is the calculation. Total, private, business. Okay, and you don't have to, like I said, guys, if they give it to you like this in the question, then you don't have to show it here as well. Especially if you're under time pressure, you might choose not to do it. But at the same time, if you've practiced it as many times as I have, or on your own, not even as many times as I have, if you practice it a lot of times, by now it should be very quick. Find a way that works for you. That's what we do prepare for exams. That's literally what preparation means. Right, so this is business kilometers traveled. So now we're going to look at the deemed cost table. And I'm going to just, so we make it a bit easier, I'm going to just put down my skeleton and fill it in. So I'm going to look for the fixed cost per the table. Then I'm going to calculate the fixed cost per kilometer. Then I'm going to have the fuel cost per kilometer and the maintenance cost per kilometer. Now this vehicle of hers had a cost of 420,000 rands. Now you go to your travel allowance table, in this case over here, so same principle applies, will sit in this column over here. Right, so fixed cost 113,179, fuel cost 127.2, maintenance 58.2. So 113,179, fixed cost per kilometer 113,179 divided by 32, 6 or 26,000 kilometers. Which one? Always by the total. Remember, the car costs you money whether you drive it for business or for pleasure. Fuel cost given to us, I always round everything down to 1 decimal here. Some solutions, some places might show you to go further. That's fine. I prefer 1 because the deemed cost table is also just rounded down to 1. So I like to be consistent. So 539.1 cents. This is the deemed cost per kilometer. Okay, that's the deemed cost per kilometer. Now, in this question, if I recall correctly now, let's go and see again, she didn't have anything else. No, she didn't have actual cost. All right, so now we can calculate our taxable travel allowance. Let's calculate it as our travel allowance, which is 5,000 rands a month. Less our business travel, and our business travel is the business kilometers, 26,000 times, right, remember guys, if it's 1 million or something like that, you probably aren't using cents correctly, so just pay attention. So that means 60,000 there. We can claim up to 140,000. Doesn't mean we have a negative amount here, it just means the taxable portion, the taxable travel allowance portion is null, so nothing. So all of this big work here for nothing. Feel that frustration and pain of the learning process. Right. Then what we have now we have, we have our CDT. Right, so let's actually just do it here before I add everything up. This is 654,600. Right, capital gain. Capital gains tax, let's say like that, taxable capital gain. Okay, so what we do is we add up everything in our CGT column. There was just the one 6,400. From that, we deduct our annual exclusion. The annual exclusion, whatever it is, in this case, 40,000 rands. Right, this gives us the aggregate capital gain, which is null. To that you add or deduct, depending on how you see it, your capital loss brought forward, which is nothing given to us. This gives us our net capital gain. Now, again guys, I want you to go through this whole process in the exam, because first of all, these terms you see here are defined in the 8th schedule. Some of those earlier paragraphs, you go and look at them. They tell you about it. So first, I want you to do that. Second, I want you to pay attention, especially when you're studying, to these terms, because it is sometimes possible that they tell you in an exam, the aggregate capital gain is, and they give you an amount, and you have to know where it sits, so that you don't go and deduct the annual exclusion. And also, this forces you to consider everything like the capital loss. All right, I want you to then also write down the inclusion rate, even though you can see there's nothing in this case. And this gives us our taxable capital gain. Now, some of the reasons why I do this is some universities and some questions, what happens is there are marks allocated here for this 40% and this 40,000. So let's say you made a mistake. let's say for some reason you missed that there's any CGT, so you missed the 6,400, right? Let's say you left it out for whatever reason. So your answer then here, you think in your mind it's null. So then you leave everything out. But in the mark plan, they give marks here because the students that did do 6,400, or let's say if this answer was actually 100,000, right, the students that did do that would have gone through this whole process, so they would get marks for these things. So that's why I want you to write it down, because in case you messed up and it's still there. If you don't want to do it, if you think it wastes your time, then that's your professional call. Okay, so we add up everything here. And this is our taxable income. Now again guys, the next part you need to do correctly. You all have the skill for this, otherwise you wouldn't be a postgraduate student. I'm just using what we've got in the solution. You go to the tax table, the correct tax table, you put in your correct primary rebate, then you do section 6A. In this case, they tell us, if I recall correctly, it's she and a daughter, yes, a 7-year-old daughter, so it's a taxpayer and one dependent. So section 6A always has rules in it that says things like what is the amount for the taxpayer and one dependent, and then for every additional dependent. Again, these amounts are not correct. Look at the correct ones that you've got. Don't memorize them. Right, so it's 300 for the taxpayer, 300 for the first dependent, and that's for 12 months. Right, so again, the principle is important here, guys. It's not the correct amount. Right, section 6B. First, we start on medical aid contributions. Right, and the question told us it is 2,500 rands a month. From that, we deduct 4 times section 6A. Whatever your answer is there, right or wrong, 4 times that. You get your mark for showing that you've used. So if you messed up, obviously this is not the correct amounts, but let's say you did this in the exam, you used my incorrect amount. You wouldn't get your mark here, but you still get your mark over here, because you're using whatever you've got. Right, then we have to look if there's any other qualifying medical expenses, which we did have. From that, so this is all, guys, obviously just a process that you need to have memorized. From that, you deduct 7.5% of taxable income. So whatever your taxable income was, right or wrong, you must use your amount. So remember, that's why it's important. Don't change your totals once you've calculated it. And this times 25%. So it's null. There we go. So unfortunately nothing. Right, so add everything up here. This is your net normal tax, or your net tax, if you want to call it that. Right, basic income tax, I'm saying it's excluding all my other taxes. Then less our prepaid taxes. And in this case, we know that there's just pay as you earn. And they gave us that pay as you earn somewhere over here, 130,000. So that's amount, that is 130, remember what it means again, just in case. That 130,000 rands means you've already paid 130,000 of that 165. So you just need, or she just needs to pay in 35,814, and this is her tax liability. And that's it for this question, guys. Hope it went okay. Make sure to work through it again. and to go and look at the areas where you might have gone wrong. You can do it.